TFSA versus RRSP. Now, this is probably one of the most popular questions I get from clients. And the question is, should I be contributing to my TFSA or should I be contributing to my RRSP? And today we're going to go over that. But before we go over that, we're going to lay some foundation. We're going to talk about what exactly is a TFSA, what exactly is an RRSP, and then from there we're going to go into the differences and speak about, what circumstances would lead you to invest in which vehicle. So let's start off with an RSP. An RSP is a registered retirement savings plan that's meant for saving for retirement, as the name suggests, right? And essentially, what can you invest in an RSP? You can invest bonds, stocks, ETF, your typical investment stuff that you get off the shelf if you go to any traditional financial institution. The other thing is you could also invest in other things outside of that, but let's just keep it simple for now. But all the things available in traditional financial institutions, you could put in an RSP. Right. The next thing is tax deduction. That is one of the strong benefits of our RRSP. The thing is, when you contribute to the RRSP, it lowers your income. So if you make, for example, $100,000 this year and you contribute $20,000, your income lowers from 100,000 to 20,000 because the 20,000 you contributed in RSP is treated as a tax deduction, right? And in circumstances like that, what may be provided is some type of a tax refund because the government looks at your situation and says, well, we taxed you at 100,000, but effectively your income for the year is 80,000. Now, once that money goes in an RSP, it is tax deferred, which means while it's sitting in that RSP, you do not pay taxes. So generally at a high level, that's an RSP. Now let's talk about a TFSA. A TFSA is a tax-free savings account. Now you could save, again, the traditional investment products, bonds, stocks, ETFs that you probably get from off the shelf at any traditional financial institution. You could take that, you could invest that in a TFSA. Now, when you contribute, you do not get a tax deduction, but the benefit is it not only grows tax-free, but when you pull the money out, it is also treated as such, meaning you're not taxed when you pull the money out. And that's why a lot of people love the TFSA. And a lot of people may have certain challenges or certain reservations about RSPs because their concern is that they're going to be pulling money from an RSP and it's going to be taxed at some point, right? And we're going to talk about that and when you should be considered an RSP and not, right? Okay, now how old do you need to be to contribute to an RSP? There's no actual age limit. I know a lot of people believe that you have to be 18 years old, but quite frankly, you just need to earn employment income and business income to have that room. And if you have the room, you can contribute. So if you're 16 years old and you're making, decent money and you're making sufficient money to get the room, then quite frankly, you can start contributing RSP then. With a TFSA, though, it's a little bit different. You must be at least 18 years old and a Canadian resident to contribute to a TFSA. Now, how much can you put in? For an RSP, you could contribute up to 18% of your earnings from last year. And for 2024, that amount is maxed out at 31,560. But not only do you have this year's room, but you have room from previous years if you haven't used it. So essentially, it's this year room, 18% of your earnings from last year, but it's maxed out at 31,560 plus any additional room. Now for the TFSA, annually you have a certain amount of room that's granted to you. For 2024, that amount is $7,000. The total amount is $95,000 if you have been a permanent resident and over 18 since 2009, right? And that amount, it changes over the years. 1 year is actually decreased, but in most instances, what happens is the contribution room increases. So that's how much you could put in for the RSP. That's how much you could put in for the TFSA. Now, what if you pull money out? Now, if you pull money out, you have lost that room if it's an RSP. So if you have say, $50,000 room and you've maxed out that room and you pull 10,000 out, you only have 40,000 that's sitting in there. That's the room you have. You cannot get that $10,000 back. You've lost it. TFSA is different though. If you have, say, for example, $90,000 and you pull, say, $20,000 to buy a car, and this is the year that you pull the money out, say it's 2024. This 2024, you pull $20,000 out. You're gonna buy a car. You get your bonus of $20,000 and you want to put in, but you've maxed out you maxed out your TFSA for this year. you're not going to be allowed to put that money in without some type of penalty until next year. So you have to wait till the following year, and once you have the following year, that amount is added back into your room. So that's a big difference there. So you have to think twice if you're pulling from your RSP, because you know that once you pulled, you lost that contribution. Where TFSA, there's some flexibility there. You say, okay, you pull this year if you need to, but you get the room back and you could, go back and contribute again. Now, do you pay taxes? If you put money from an RSP, yes, you pay taxes, and it's treated as ordinary income, which is typically the highest level of taxes that you're going to pay. But at least the potential for it is the highest, 53.53% as of today, where we speak. Now, when you pull money from a TFSA, there's no taxes there. Again, we've said that a few times, but it's worth mentioning. Okay, how much you make now and what you think you'll make in retirement is a huge part to consider when you're contributing to TFSA. Let's talk about how much you make now, and then we'll talk about retirement. If you're making, say, $50,000 or more, it's worth looking at an RSP because of the amount you contribute. There's a tax deduction element to that, and you'll save on taxes. The perfect reason to use an RSP is for you to contribute when you're at the higher level of income and to pull money out when you're at a lower level of income. So, for example, if you're making over $200,000 and you contribute to an RSP, and this is money, you're making over $250,000. This is money that would essentially be taxed at 53.53%, right? But you have structured and have a plan in place such that when you go to pull the money out, you're at a much lower income bracket. That would be essential for an RSP. And that's one of the benefits of an RSP. It makes no sense, for example, if you contribute when you're at 50,000 and at your retirement you're at 70,000 because you earned it when you would have paid you'd have paid a lower tax rate. I know you're pulling it when you're paying at a higher tax rate. Granted, you get the benefit of a tax deferral, but it's not as effective as if you would have contributed when you're at a higher income rate and then pull it out when you're at a lower income rate. That is where a lot of people have challenges RSPs, and that is where the planning aspect of it comes into place. Because what you want to do is structure your financial plan in such a way that you contribute when you're at a higher level and you withdraw when you're at a lower level. If you haven't done that, in some instances it could actually be counterproductive, right? So that's the thing to consider with an RSP. No, if you make less than $50,000, there's no real tax deduction there, and even if you have the room, it may not make sense to contribute to an RSP, and so a TFSA makes absolute sense, right? So that's usually my consideration. Now, let's speak to retirement as it relates to TFSAs. Very, 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 very important. TFSAs are great for retirement planning because it gives you that flexibility to prevent clawbacks. It gives you the flexibility to not be hit with penalties if you're getting certain government benefits. And quite frankly, what you're able to do is look at a certain amount that you want for that particular year, and you could use the TFSA as that buffer that puts you below certain thresholds so you're not taxed as much. And as we mentioned before, and so certain government benefits that you have coming your way is not taken away because of those income thresholds. And the TFSA allows for that flexibility. And here's the beautiful thing, because you could, contribute in the following years, what you could do is you could use up the room for the TFSA. You get the room back in the next year, and then you could move different accounts, maybe like a non-reg account or savings accounts or whatever it is, depending on your circumstances, and fill up that gap that you have in the TFSA that continues to grow tax-free and gives you the opportunity to pull out tax-free. So just so you know, that is where a lot of the conversation usually lands for me and my clients. So again, I'll talk about this high level because this is where a lot of people have the concerns. You contribute to a TFSA when you're at your highest earning potential, maybe not the highest, but a higher income potential. And what you want to do is withdraw from the TFSA when you're in a lower income potential. TFSAs are great if you are not making that $50,000 and you're below the threshold. Absolutely, you're going to do contribute to a TFSA, And TFSA is also great for retirement because it allows for flexibility, so you don't get hit with things like OAS clawbacks, or you don't lose certain government benefits, or just for retirement planning generally. Because what you're able to do is essentially what I've done with my clients: look at the December, or look at the top of the year, and we go, this is how much you'll need based on your spending last year, based on inflation, and we can be strategic about exactly how much money comes out. We look at CBP, we look at OAS, we look at non-regs, we look at all the different um, vehicles available to us, and we can literally plan what the taxes will be for this year. No, things may happen, inflation may happen, and mid-year you go, well, our expenses are much higher than we thought, and we make changes, right? But it at least gives us that flexibility to still control our taxes, and it's huge for retirement planning, right? I don't want to talk too much about this because I think I kind of hammered it home. But again, the flexibility of TFSA is huge because when you pull from a TFSA, there's no taxes, and it just shields you from a lot of penalties, a lot of taxes, and a lot of benefits that you would have gotten, you may have lost if you pull it from something like an RSP that's going to be treated as ordinary income that increases your income, and so you probably will not be qualified for certain things. So that TFSA flexibility is really unparalleled. I mean, it's a great vehicle. I think it's amazing. The only my only my only downside is the TFSA doesn't have enough room, and slowly, of course, it increases year by year. Okay, so what are you saving for? When you think about RSPs and TFSAs, that's an important thing because for RSPs, for most circumstances, you're thinking long-term retirement. No, the one exception that I will highlight is, for example, using your RSP for a home buyer's plan. A home buyer's plan, depending on where you are now, could be like a midterm goal. I call it a midterm goal, 5 years, 10 years goal. And you may look at an RSP, okay, let me keep contributing to this RSP. And at some point in the next 5 years, 3 years, 10, 7 years, wherever you are, I will be pulling from that to purchase a home. So even though the vehicle sells for long term, I always say, then take a pit stop. And so for a midterm goal, I think, RSP, the home buyer's plan, is a great opportunity. Now it's being increased from 35,000 to 60,000 starting April 16, 2024. And that money has to be contributed back. So if you take $60,000 out over the next 15 years, um, you have to contribute that $60,000 back over the 15 years. Otherwise, it's going to be treated as income, right? So, this is where, even though we have the RSP for long-term goals, there may be opportunity to plan midterm there. For other situations, like a car, certain appliances, things that you want to do, which are larger items, I think the TFSA is a great opportunity. It's a great vehicle to look at. I may provide you with the feasibility to do that. That being said, I will also stress that with a TFSA, I think it's super, 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 super important to consider using it also for long-term planning, just because you have the opportunity to pull that money out tax-free. And one more thing I will add, by the way, when you pull from the home buyer's plan, it's not treated as income, unlike any other circumstances. So between a home buyer's plan and you're pulling money for education, and if you're a qualified institution, there are some exceptions there. But that being said, other than those two exceptions, when you pull from an RSP, you're going to get taxed. No, choosing between both. I've said a lot. Simply put, if you're just starting out and you're not making a lot of money and you're below $50,000, quite frankly, the TFSA is probably going to be the best bet. Once you start earning more income, the RSP is going to be something you look towards. However, you have to be strategic in that you have to plan when you're taking that money out. And essentially, what you want to do when you contribute to an RSP is contribute when you're at your higher income potential, pull that money out at a later date when you're in a lower income bracket. In fact, there may be circumstances before you retire where you're in a lower income. Maybe you've taken time off work, maybe you've been let go, whatever the circumstances are, where it may make sense to pull from your RSP because you are at a lower income and transfer it over to a TFSA, which continues to grow tax free. And when you pull that money out, it is tax free. So while there are a lot of moving parts here, planning for RSP and TFSA makes the most sense within a plan. And that's why you don't just take money and throw it in each account because it's empty or because you want to match up. You should have some plan around this. You should have some strategy around it. And it should fit in with your overall goal and your values. If not, even though you may reap some of the benefits now, for example, you may contribute to an RSP now, you get a tax deduction, you get a tax refund. However, if you're not strategic when you go for retirement, you may even be in a higher income bracket, which, yes, you've got the benefit of a tax deferral, but no, you're still paying more taxes when if you're more strategic, you could have paid much lower tax, right? And quite frankly, the biggest challenge, especially in retirement, is that you have so many things to pull from. Usually, most individuals, while they're working, they have one income source, maybe two, unless you're a business owner, you have all these different streams of income. And then you get to retirement, you have CPP, you have OAS, you probably have a private pension, you have RSP, you have a TFSA, you have a non-reg, and you have a savings account. And you're going, oh, 6, 7 different things. What should I pull from? I know how much money I want. If you're not strategic about that, you could be losing a lot of money, right? And so hopefully this kind of brought some clarity to the situation. And by the way, I know I phrased it as an RSP versus TFSA. Quite frankly, they're both meant to be worked with, worked side by side, because many people use them and get the best of each. And quite frankly, that's how you want to use it. Depending on your circumstances, you pull out that tool, whether it be the RSP or the RSP or the TFSA, or maybe just the TFSA, maybe just the RSPs. It depends on your circumstances. But again, I hope I was able to bring some clarity to this. Have a wonderful week. Next week, I'll also choose a topic, usually based on conversations I have with a client. And I'll come here, talk for 8-10 minutes, and then I'll sign off. Have a wonderful week. If you found this information helpful, like, share, subscribe. Take care.